Hello, everyone, and welcome to another episode of the VMC Inc. Financial News Network. I'm Victor Campos. So, we're experiencing a period of volatility, strong volatility in the US stock market, and that might get you worried about your future financial situation. So, this is going to be the top 5 tips to survive the financial instability of 2016. And these 5 tips actually will apply to any period, either of negativity or positivity in the stock market. It's a fundamental concept, so they'll apply always. Number 5. The first thing you want to do is set up an IRA. This is an individual retirement account. Anyone can set these up at any financial institute. You can go over to your credit union, your local bank, you can go anywhere. There's no right or wrong place really to set it up, although you do want to look at fees, what fee structure there might be, and other such little gotchas that eat away at your money. I'm just going to use the example here of TD Ameritrade. I've used them for a few years. I like what they offer. But this is one of many possible financial institutions where you can set up an IRA. Send an email via the link in the description to get an offer from TD Ameritrade. So this step requires for you to open a new account. You can go through the process. There's a lot to answer here, a lot of steps to complete, but this is going to be necessary, so you'll need to go through this process. But perhaps one of the most important aspects of the setup is that you're going to be setting up an IRA, either traditional or Roth. Depending on your financial situation, you can consult the wizard here to choose the best one for you. But you'll get some feedback about why traditional might be good for you, Roth might be good for you. You need to figure this out yourself. Either way that you set this up, the great thing about an IRA is that it's a special financial instrument, and you'll be able to take deduct that from your taxes or not. So the point of that is that you're going to add money to an IRA. It's kind of like a savings account, but better in many ways. You're going to add money to your IRA on a regular basis, and then it's going to grow. It's going to pay dividend or interest, and it's going to grow. The good thing about that is you will not be taxed when you reach retirement age and you start pulling money out of it. Depending on which of the two it is, you won't be taxed on it either. You can start off, so one possible scenario is you can start off with a traditional IRA depending on your age. So you're going to contribute, let's say, $100 a month into your traditional IRA. At the end of the year, whatever you've contributed into it, you can deduct it from your taxes, with some nuances, of course. Check your tax professional. Then, years later, when you're in your retirement age, you can roll over the traditional IRA into a Roth IRA, so that now you can start to deduct or take distributions from your Roth to live off of, and you're not going to be taxed on that. So that's a little more complicated than we can get into at the moment, but that's the 5th step that you need to do. The step number 5 is set up an IRA. Let's say you've gone through the process of setting up your IRA and you've got an account. So I've got an account here, it's set up. What I then want to do is I want to populate it with stocks and bonds. That'll be a tip a little bit later. But what we want to set up with your IRA, if your financial institution offers it, is to set up the Dividend Reinvestment Plan, DRIP. So here on Ameritrade, under the My Accounts tab, you can go to Dividend Reinvestment. So basically, depending on the stocks or bonds, ETFs, etc., that you invest in, they will often give you a dividend. They will pay you money for simply owning the stocks. It's like getting interest from a bank account. But oftentimes, depending on the company, these dividends will be much higher value than a plain old bank. Well, you're going to be getting money from owning these stocks. Why not reinvest the money that you're getting to get more shares of the stock? Let's say you have one share of a stock. Let's say it pays some amount of money, and then you're able to then buy half a share, another half share of that same stock. Well, now you've got 1.5 shares of that stock. Next time you get another dividend, you might then have now enough for another half stock, which will give you 2 stocks. So without you having to purchase another share of a stock, after some amount of time, you've got 2 shares of the stock. And those 2 shares are going to keep paying dividends. Then that's going to give you more shares, more dividends, more shares. It's going to compound. Your money will grow at a faster rate than at a bank. So here on Ameritrade, this is the screen where I would set this up at. I would enroll, set the enrollment so that automatically enroll all current and future eligible stocks and ETFs in DRIP. If I forget to activate this when I buy a stock in the future, I could be missing out on this reinvestment. So the cool thing here is that I can set it that any new stock that I add or any new ETFs or bonds that I add to this account will automatically reinvest itself. And so the point of using DRIP is to grow your shares. The more shares you have, the more value your account has, and the more dividend you pay yourself. So you keep growing your seed. Step 3. We want to populate our account with stocks and bonds. Let's say we're investing $100 monthly. If we simply added $100 but not tied it to any stocks and bonds, the money won't grow very quickly. Just like at a regular bank, to grow your money, you need stocks and bonds. Well, what stock should I pick? Should I go with Apple? Should I go with Google, Facebook, Twitter, Etsy, Johnson & Johnson, ExxonMobil? There are so many stocks to choose from, and as the market is showing in this year, 2016, it's being a bad year for stocks. The markets are losing value, so how can you pick the right stock to not lose your seed money? That $100 could decrease to $98, or it could increase to $105. So one of the safest ways to grow your money is to, instead of investing in individual stocks, invest in baskets of stocks. And from previous videos at the VMC Inc. Financial News Network, we've talked about ETFs, exchange traded funds. So that's step number 3, invest in ETFs. But Ameritrade has this amazing feature where you can actually work with commission-free ETFs, because every time you buy or sell a stock, usually there's a commission. This can range from $2 per trade, $4 per trade, $9 per trade. So let's say worst case scenario, you're being charged $9 per trade. Every time you invest your $100 into your IRA and purchase another share of an ETF or a regular kind of stock, let's say Apple, you are then charged $9 simply to purchase it. Any regular stock. With ETFs and with TD Ameritrade commission-free ETFs, you're not going to lose that $9 per transaction. So this is the 3rd step. You want to go over to the from the menu, you want to go over to Research and Ideas. In the ETF section, commission-free ETFs. You click there, there will be a couple of clicks, a couple of items to activate. this account's been activated, but you can simply, there'll be a button to click on it. It'll tell you what you're about to do. Basically, you will not be charged a commission as long as you hold the ETF for at least 30 days, and you will be holding on to it for at least 30 days. So you activate this ETF, these commission-free ETFs, and then you're going to be listed with a bunch of ETFs. These are baskets of stocks. Instead of choosing one stock, the wrong stock, you choose an ETF loaded with stocks. Step 2. There are so many ETFs to choose from. And here are a few that we recommend at the VMC Inc. Financial News Network. Let's go over here just to show you. I've got a watch list set up. A list of ETFs that we recommend. Again, on previous videos, we've mentioned the ETFs and why we recommend them. And so we've got these Vanguard ETFs, an ETF that focuses on bonds, that's BND, and ETFs that focus on stocks, either domestic or international. So any of these four will be great investments to power your IRA. You're going to be gaining dividends from each of these. They will be tax-free because they're in the IRA. And these are some of the best ones because they have a low expense. You're not going to be charged the $9.99 or so per trade, but you are going to be charged for the fund, for owning the fund, a variety of prices, but these average at about 0.1%. So you're going to be charged a nominal fee to own these stocks. These ETFs, these collections of stocks. So depending on many factors, you need to decide the ratio of stocks and bonds. But one good ratio is a mixture of 25% bonds and 75% stocks. So it would be any of these other ones. So let's say you've added $100 1 month. That's enough to buy you one share of BND, which is Vanguard's bond index fund, or one share of Vanguard's total global fund, or one share of Vanguard's total US fund, or one share of Vanguard's high dividend yield. To make it really easy, one possible recommendation is you're going to be buying BND and VYM. BND for the security of bonds, and VYM to grow your money faster. So as you add $100 per month, you'll be able to purchase either BND or VYM to keep a ratio of 25% BND to 75% VYM. So looking at the chart here, in 1 year, BND has shown a downward trend, as most bonds are experiencing at the moment. But looking deeper at the data, like on one of our other videos, we show you here how BND pays a healthy dividend every month and every quarter. So even if the value of the single ETF is decreasing, you're still profiting from the growth via dividends. In this hypothetical portfolio, we purchased one share of BND at the beginning of 2016, and its value has increased 0.84% since purchase. Not so bad. And the other ETF is VYM. Now again, in 1 year, it hasn't looked so hot here simply on stock price value. So on paper, this might have lost money. But in a more tangible sense, throughout the year, it has been paying a great dividend. The return on this is better than any bank interest rate. ETF has lost 5.37%, which is a relatively big amount, but many, or if not every, part of the global economy is suffering at the moment. But you're going to have a strategy of purchasing BND and VYM, for example, so any bond that you're comfortable with and any stock ETF that you're comfortable with at a 25% to 75% ratio, and then you're going to execute tip number 1. Tip number 1 is wait. This particular chart shows that since purchase, this ETF has decreased 5%. That doesn't sound so good. But since purchase has been January 3rd, 2016, and it's currently January 16th, 2016. This is not enough time to get any sense of how well this fund is doing. So you're going to wait. You're going to hold on to these ETFs for a year, 5 years, 10 years, 15 years, 30 years, whatever your retirement time horizon is at. Because in all of that amount of time, your money is going to be growing much faster than a bank, much more effectively than a bank. Again, this chart here shows the BND fund in 1 year has been on a downward trend, but all these little D's mean dividends. You're getting a monthly regular dividend, 16 cents per share. 15.9 cents per share, 16 cents per share, etc., etc. It's pretty consistent at about 16 or 17 cents per share. So every one share that you have, you've gained some cash. There's also, in addition to the regular monthly dividend, there's the capital gains long term. So other instances where you gain even more from the fund. Couple that with, what if you own 10 shares, 100 shares, 1,000 shares of each of these? In a year, you've accumulated a lot of money. In 3 years, even more from dividends. In 5 years, even more. In 10 years, the longer you hold on to these, you're accumulating money faster than a bank. And there's going to be periods of volatility, positivity, negativity. But depending on your time horizon, that might just be a speed bump, depending when you retire. Let me compare this with our other recommendation. Not only are we investing in BND, we're investing in VYM, Vanguard High Dividend Yield. So this is a fund that really focuses on getting you dividends. So these are quarterly dividends with this fund, and so here was a dividend of 46 cents, 56 cents, 52 cents, 59 cents. So if I had one share, I'd be getting, a few dollars out of it every quarter. If I own 10 shares, more, 100 shares, even more, 1,000 shares, even more. The more shares you own, the more money it makes. And since we've got DRIP activated, it keeps purchasing more shares of itself. I perhaps don't have to keep investing that $100 to purchase more shares. I let this grow on its own. It'll take a little longer to grow on its own if you're not feeding it a little bit here and there, but it's going to keep growing, and you're going to follow tip number 1. You're going to wait. You're going to wait out the negativity. You're going to see the positivity, because in the long term, the stock market is a great investment. We can look at 100 years of data to show basically everything rises. Here's what VYM looks like in 3 years. An upward trend. Yes, there's the dips, but there's the peaks. And in general, in 3 years, really big increases. In 5 years, again, upward trend. In 10 years, there was the big financial crash, of course, of '09, but then it recovered and tripled from that crisis. Perhaps another crisis is coming, but it'll recover. And so that's why the best tip that we can give you is wait. You want to basically buy and hold. You want to follow our 5 tips, and the number one is to wait. So to recap, you are going to set up an IRA, either traditional or Roth. You're going to set up dividend reinvestment to grow more shares of your ETFs. You're going to invest in commission-free ETFs, specifically BND and VYM as an example, of a ratio of 25% to 75%, and then you're going to wait. You're going to let that money grow. Perhaps one more tip would be keep funding your IRA. Keep contributing. As of this moment, you can contribute up to $5,500 tax year 2015 and 2016. So these funds, when you feed it that amount of money, for example, here under performance, if you had VYM, you invested $10,000 in 1 year. This is what the ETF did, and it's worth a little bit over $10,000 in 1 year. If you invested and held it for 3 years, that $10,000 would be $14,000. If you invested $10,000 in 5 years, that would be up to $18,000. So the more you invest, the longer you wait, the more this will be worth. That's the big secret to investing. Commission-free, ETFs, buy and hold. Hopefully this gets you thinking about how you can start your journey to a sound financial strategy, because in the short term it might look scary, but in the long term it'll work out. So good luck. This is Victor Campos for the VMC Inc. Financial News Network. See you next time.